Well, for the global economy, for economies around the world, for people around the world, getting inflation back under control is hugely important. It is the overwhelming and overarching priority right now, and that is why we say unequivocally that central banks need to maintain monetary policy tightening until such time as inflation has come back to target. It's very important not to overreact and not to draw the wrong conclusions from what happened with the Silicon Valley Bank. There were some very specific reasons, there were some very specific circumstances there, and certainly it raises a whole range of questions for regulators and policymakers to answer, and indeed we must get to the bottom of what happened and why and address those issues sensibly. And yes, I mean, in the wake of the failure of the Silicon Valley Bank, there has been market jitters, there's been certain reactions from markets. But fundamentally, our view is that the financial, I mean, the capitalization and the capitalization of banks in the US and globally is sound, is much better. It's a very different situation compared to the situation in the lead up to the global financial crisis. And while of course we will need to continue to monitor the developments and need to continue to ensure that we minimize and eliminate the risk of contagion. I mean, we don't see right now that there is an overall risk of banking system failures.
From where I'm standing, Secretary General, it seems that you're suggesting that the risk of seeing a potential economic crisis emerging from the fact that central banks are being quite aggressive with their rate hiking cycle is worth it just to address this high inflation.
Well, we need to get economic growth back onto a more sustainable foundation and trajectory for the future, and we need to ensure that we get inflationary pressures back down. I mean, that is the overwhelming priority, to get inflation and the price pressures that come with high inflation back under control. That's right, and I mean, to the extent that individual businesses have made bad decisions in terms of their business model or in terms of their activities. I mean, that is not a way. That is not a reason why we should step away from the overarching policy priority, which is to get inflation back to target.
Now, you've said that some of the, looking at the banking sector, that it is quite well capitalized and we are not in the same situation back to what we had in 2008. But what is the risk of seeing a financial crisis emerging at this stage?
Well, at this stage, this is what I'm saying. I mean, we don't see that there is a risk of a broader financial crisis at this stage. We believe that the regulatory settings in the US and around the world are significantly improved compared to what they were. Certainly in relation to systemically important banks, the capital adequacy arrangements that are in place and all of the other supervisory measures that are in place have been effective. And we don't believe that there will be overall contagion. But, this is something that we've got to continue to monitor. And there is certainly market volatility. There's turbulence in financial markets, and we've got to keep an eye on all of that. But there are some very unique reasons linked to the business model, linked to the high concentration of the particular bank in one sector, in one geographic area, making certain decisions in terms of their own investment activities that have led to this situation. And I guess one question for policymakers in the US to answer is whether it was appropriate for a bank that is so concentrated in such an important sector of the economy to not be subject to the level of supervision that applies to systemically important banks.